Good day, I'm Rob Tatro from robtatro.com. Thanks for coming today. We're talking about liquidity. Liquidity is a concept a lot of people don't understand. It actually means converting or having an asset class that is convertible to cash or cash-like instruments that you can spend and use in your day-to-day life. Think of an investor, an individual who's got all of his assets in one single investment. It's a high rise. It's in a remote city and somewhere in Canada, and really tough to sell. That would be a very illiquid asset. The only way he can get his cash is he needs to sell that entire asset to one specific buyer. The other end of that spectrum would be actual cash sitting in a bank account. That is a fully liquid portfolio. In between that, you have all sorts of different portfolios or net worth statements. Specifically, what we're talking about today is individuals who have either too much or not enough in liquid assets. So that could be that all of your assets are in an RRSP or a registered account or a locked-in retirement account, an account that you're not able to pull the money out of. That would be not liquid. So think of all your assets are in an RRSP. You have no tax-free savings account. You maybe have some registered education savings plan money, and then all of your other net worth is in either homes, cottages, real estate, and other illiquid assets. You'd be a very illiquid investor, and that's can be a concern for you. So what we want to make sure is that you either have some of your assets when we do our planning, when we sit down, and when we're talking about today, is making sure you have some of your assets that are in an account that is liquid, meaning a tax-free savings, and then tax-free savings or a non-registered account, and then also having assets specifically that are liquid. So you need to have them in an account that's liquid, and you need to have actual assets that are liquid. Stocks, very liquid. Bonds, historically, a little bit less liquidity, and then you get into preferred shares, you get into some debentures that might not be as liquid. In your portfolio, you should definitely consider and you should definitely have a portion that is liquid. The most liquid stocks are the most highly traded stocks. So you think of your Canadian and US large cap companies, they are highly traded. There's a ton of volume every day on the market. Therefore, they get traded a ton. They are highly liquid. Sometimes you get to a situation where you have a stock or a preferred share or a debenture or a penny stock that has no bid, that has very little liquidity. You could not even sell your share if you wanted to. That's the opposite of liquidity. And then generally what we see is as a company gets more mature, as it appreciates over time, as it has a stronger balance sheet, it generally graduates from one exchange to another. It gets on the TSX. There starts to be trading volume. And once there's trading volume, there's liquidity. And we'll generally see what's called a liquidity bump on the value of the stock. We believe in liquidity. We think it's very important. We think people should have it not only in their accounts, but also in their net worth or on their balance sheet or in their personal net worth statement. So you got to make sure when you're looking at that, you got a bit of everything. If you're not sure, obviously you want to consult your tax professional or ourselves or your portfolio manager, your financial planner. It's a really important concept, and if you get caught on the wrong side of liquidity, you could really get crushed and devastated through having to sell an asset at a depreciated value. You want to be able to control when you sell your assets. All right, that's it for today, folks. The way it works, sign up, register, become a viewer of our YouTube channel, and that'll allow you to get the future videos. You get the notice of when we come out. Please comment, like us, and share. Thanks.